Good day, ladies and gentlemen. Thank you for standing by, and welcome to today's presentation, Embracing the New Revenue Recognition Standard, Keys to a Successful Transition. Your host today is Kim Odom, Director, Vertical Marketing, Software Industry. I would now like to turn the conference over to Ms. Odom.
Welcome, everyone, to today's webinar, Embracing the New Revenue Recognition Standard, Keys to a Successful Transition. We have a great speaker lineup today, and I'd like to quickly introduce you to the people who will be leading the session. First is Dan Miller, General Manager for the Software Vertical and Vice President of Finance. In addition to leading software industry vertical at NetSuite, Dan serves as VP of Finance, where he spends 25% of his time advising on mergers and acquisitions, as well as heading up our Finance Steering Committee. Dan brings over 25 years of professional finance and accounting experience to NetSuite, most recently as Senior Vice President and CFO of Nexent, a global provider of software and services to the energy industry, where he managed accounting and IT corporate service groups. He also led the financing and investment initiatives to support the company's strategic growth plans, overseeing both investment and capital raising activities as well as M&A. Dan began his career as a senior accountant with Deloitte, subsequently serving as a senior treasury manager for Genentech and corporate controller for Extreme Networks before moving on to executive and CFO roles. Our next speaker today is Trang Wang, a partner at Deloitte. Trang focuses on technology, media, and telecommunication industries and has over 20 years of experience in public accounting, providing assurance and advisory services to startups, mid-size and large multinational companies filing under VAS, U.S. GAAP, IFRS, and SEC reporting requirements. She has in-depth knowledge of emerging complex accounting issues and related implementations, as well as risk management and related internal controls to supporting and reporting operational efficiencies. She brings experience from recent projects of a similar scope with Deloitte clients. Her engagements include reviews of revenue accounting irregularities, assessment of operations and systems environments, IPO carve-outs, development of reporting packages, and accounting policies. Trang has worked on projects involving corporate governance and business processes. In addition, she's led projects on IFRS and other complex accounting implementations and SOX readiness implementations and attestations. Our final speaker today is Stephanie Zamora, Director of Financial Operations at Hortonworks. Stephanie is a Silicon Valley native and seasoned startup veteran. She's initiated finance functions and ERP system architectures for technology companies across a variety of verticals. At Hortonworks, she's laid the accounting foundation necessary to handle accelerated growth and complexity as the company has become a major player in the big data space. Previously, she was a key contributor in architecting factory reporting capabilities as manufacturing finance manager at Neosol, a high-volume solar manufacturing company. Prior to Neosol, Stephanie was VP of Finance and a founding member of Neoconics and played a key role in the launch of that semiconductor technology venture. With that, I'd like to quickly cover today's agenda. First, we're going to hear an overview of the new Rev Rec Standard, ASU 2014-09. Then we'll move into discussing the specific impacts this will have on processes and systems. Then we'll move into some tips around getting started. And finally, we'll end with your questions. I would encourage you to ask questions through the Q&A panel and WebEx throughout today's session. And with that, I'd like to move into the next slide where we get our overview of ASU 2014-09. And with that, Trang, it's my pleasure to turn it over to you.
Thanks, Kim. This will be a quick refresher. Clearly, this guidance will go pretty long if we really get into the details, so hopefully this will get you comfortable enough that we can start talking about the rest of the challenges that companies will face. But after a number of delays, the FASB and ISB finally issued a new revenue recognition standard that is really meant to be a one-size-fits-all and eliminates many of the industry-specific guidance. Next slide, please. This is the most converged standard to date since the two boards started working on convergence efforts. In the discussion of the transition guidance, for a calendar year-end company, the standard is effective January 1st, 2017 for public companies and a year later for private companies. While early adoption is not permitted under U.S. GAAP, IFRS does permit early adoption. IFRS also does not necessarily dictate non-public companies because they have different guidance. So for them, it's really for public entities. The two transition options that are available are the full and modified retrospective approaches. Under the full retrospective method, the financial statements would reflect the impacts of the new standard as if you adopted it as of January 1st, 2015, which is really coming up. While the modified approach reflects a cumulative catch-up adjustment to retain earnings. The SEC recently indicated that it would not object if a registrant reflects the adoption of the standard in the 5-year table in a manner consistent with the financial statements. So you would just report the legacy gap for the other years. However, registrants should disclose the method used as well as that the periods are not comparable to each other. I will say one thing that has come up in conversations with different companies is that for certain companies, there may be significant acceleration of revenue. So even if you choose the modified retrospective approach, companies should consider whether they should analyze the impacts to prior years to better communicate with investors, analysts, the board, and other stakeholders, including impacts to agreements such as debt covenants. Next slide, please. The standard applies to contracts with customers only. This may not necessarily be a simple task because some contracts could be interpreted more as a contract between partners. When you think about some of the agreements where you may be doing research together. I know recently had conversations with a company where they had some investment that was happening regarding research with the military, for example. And so in those cases, would that be considered a customer or would that just be, a partnering type relationship? In certain regulated markets, for example, the energy space, the contract may really be considered with the regulators who set rate restrictions rather than the end-use customers. So in that case, there has been some discussions regarding whether the interpretation is that those are customers or not. And in the healthcare industry, there are questions as to whether certain contracts from, healthcare providers are scoped out as insurance contracts, and those are also up for discussions as well. Contracts could be verbal or written, and differences in local laws governing enforceable rights and obligations may result in different conclusions, and that would impact those that would have to think about international implementation. Next slide, please. We'll spend some time on this slide. The key component of the new standard is really to recognize revenue that reflects the consideration that the entity expects to be entitled to. While there are 5 basic steps, there is significant judgment and estimation that companies would need to address and get your auditors comfortable with the conclusion. While the accounting conclusion for some may not significantly change, the ongoing analysis required to support such conclusion may require companies to change processes and systems to collect the appropriate data, and we'll emphasize some of this later on, as you'll see. The first step in the process is really to identify the contract. A contract would not be in scope if either party can unilaterally terminate the contract without compensation and the contract is wholly unperformed, such as purchase orders. Companies need to consider whether they would need to combine contracts. For example, if a customer enters into a contract with another part of the entity with expectation of a bigger discount because of another contract, those may need to be considered whether they need to be combined. In addition, companies should consider processes to identify whether contract modifications have occurred and would they be treated as separate contracts or whether they would impact your separation of performance obligations and transaction prices and whether they would need to be reevaluated. One thing to note is that U.S. GAAP definition of probable is a higher threshold than IFRS. So in step 1, this may result in differences between the two, as probable of collection is one of the criteria. So that may give you different conclusions depending on, where you fall in that probable range for the 2 different standards or 2 different gaps. The next step, identifying the performance obligation, may be different from current software guidance. So, some questions to think about is, can the customer benefit from good or service on its own or together with other readily available resources? And is the good or service separable from other promised goods or services in the contract? For example, I had a discussion with a client recently in the question of, whether a secondary refurbished market allowed customers to benefit from the good, even if the company may not sell the hardware separately from the software. There is a potential to separate more promised goods or services as well because VSOE will no longer be required, and we'll go through that in a little bit detail later. Renewal rights and warranties may also be separate performance obligations depending on how they are packaged, in the contract. And a series of consecutively transferred goods or services may be a single obligation. This will come into play for those that have to deal with licenses, and we'll talk about some of the requirements there as well later. The next one, transaction price, should include variable consideration. So this is subject to the constraint guidance, where it really just notes that if it's not probable that will be significantly reversed, you would still need to estimate some variable consideration all along and come up with a process to continuously change that. I mean, if the numbers will change, you would still need to make adjustments even if it's a reversal of revenue. So that's something to consider as well. Highly probable under IFRS is what they're used in the significant reversal, the constraint guidance. So in this case, because highly probable under IFRS is a similar definition as probable under U.S. GAAP, this step is actually considered converged for all intents and purposes. In some cases, consideration to customers such as volume purchase discounts should be adjusted. This may not necessarily be based on when the customer meets the requirements, but could be based on historical trends of that particular customer or a similar customer profile. So even if you have tiered rebates, it's not, in the past, people would, not record the adjustment until, a customer may have met those guidance. But in the new revenue recognition guidance, it basically will say that you would need to determine whether you can estimate that. So if they've always had a trend of meeting a certain threshold, then shouldn't you apply that percentage discount up front to the revenue that you're recording? A company is expected to estimate variable consideration based on the expected value or most likely amount methods. And so those are things that companies should consider as their significant judgment in that. Step 4 of allocating transaction price is really based on either relative standalone selling price or estimate standalone selling price. As noted earlier, VSOE is no longer really in play. Unless certain criteria are met, adjustments such as discounts should be allocated to all performance obligations based on initial allocation. If you think about the telecommunications industry where they have subsidized handsets, that created some issues for them because the subsidy is now not just applied to the phone. It would have to be applied across even like the different, wireless plans, texts and things like that. So you start seeing companies maybe changing how they package those things. You may, as well, you may have to reallocate changes in standalone selling price unless you can say that the contract modification was specific to a specific performance obligation. But if not, then you would have to reevaluate whether you would have to adjust and, again, true up the revenue up to date. And then the last step in this is really primarily based on evaluation of control. It does change from the current revenue recognition guidance and not really about a risk and rewards mechanism, but more of a control. So one of the things that you'd have to consider is whether the transfer occurred over time or at a point in time, and this is something that kind of comes up with licenses, and whether you can say that there is still control when you think about, any like upgrades, does that kind of give you a different separate performance obligation? Is that over time or is that a distinct time, and could you record revenue immediately based on that? So there's a lot of discussion on this, and I'll raise it later, but it's definitely one of those topics that's raised with the transition resource group. Next slide, please. I will highlight some of these quickly, but some of these areas we did talk about, or I did talk about earlier. But these are areas that will impact or generally impact technology companies and have been identified as topics to address by the various industry groups, including the Transition Resource Group. Since BSOE is no longer required, the question really is, would specified upgrades be considered separate performance obligations, or would it be something where licenses are over time? And then the other question is, what about, PCS or installation services? How would you record those? And, depending on how it's structured, again, regardless of what the contract says, where does control pass? And then I highlighted renewal options and warranties earlier, but basically if they are not standard and if there's a specific right that the customer expects from that, those may constitute different performance obligations that you would have to allocate transaction prices separately to them and then determine when control passes or when the time expires, so to speak. And that would be when you would be able to record the revenue associated with those performance obligations. Next slide, please. For those companies that have the sell-through model, this may likely accelerate your revenue. So you can no longer just say that based on whether the distributors sell it to the end customers or not, that's when you'll record revenue. Again, similar to the discounts I mentioned earlier on the tiered rebates, you'd have to come up with what you believe is the estimate based on historical trends or fact patterns or even industry norms or similar customer profiles. So again, there's different methods that companies can come up with. You just need to come up with something that makes sense and that you've got support for. And then slightly opposite with that, the concessions and like the tiered rebates, those may have it where you're not recording as much revenue up front because you would have to adjust them for those up front. While there is a practical expedient provisions for contracts less than a year, one of the areas that was a major concern is for those that are greater than a year, you would need to adjust them from a financing component, and those would need to be recorded in interest in a different part in your cash flow statement, right? So that would definitely change or continue, challenge your, margins, your top line if that's the case, and depending on how significant it is for companies. And then, as I mentioned earlier, you also get to, although you may get to a similar conclusion from an accounting treatment from the old and the new Rev Our Standard, a company would still need to provide appropriate analysis to support such conclusion, such as why you would use the residual allocation
method.
method.
Have lost your audio.
Oh.
Let me just do a quick check here.
Trang's still coming through.
Yeah, can you?
Okay, got it. Yeah, now we can hear you.
Yeah, sorry. Where I left off, I think, was that, companies will still need to do appropriate analysis to support their conclusion. I know that in the life sciences industry, there's a lot of agreements that they may have regarding, whether things get FDA approval and all sorts of contingencies. And so they may get to the same conclusion that they would still defer revenue. However, the thought process or the analysis that they would have to do to support that conclusion would be a change in process that companies should consider, what level of effort you would need to do to kind of get comfortable, with that for yourselves as well as with your auditors and potential SEC questions that may come up. Next slide, please. And I won't go through this in detail, but, even, if the new standard does not change your current accounting treatment, the disclosure requirements are very voluminous, and it may require companies to track a lot more data and information than you're used to. That's not to say that the information doesn't already reside in the company somewhere, but in some conversations I've had with companies, some of those are sitting in, your maybe your sales system or inventory system, and those don't necessarily always link to the financial reporting system. So companies should at least evaluate whether the data is out there somewhere, in what capacity. And for even companies that have a contract management system, it may require tweaks in order to capture the appropriate information that you would need for disclosures. And then I know that there's a number of companies now that because of this are actually starting to think about looking at a contract management system for, tracking all this information. There is also I would also say that this is an area where companies should assess whether changes to processes and systems may be required to really gather the information in a timely basis. So even if you do have it, the question would be, would you be able to gather it in the short close period that you would have for the public company, deadlines that you have to meet? And then the main difference here for IFRS is that IFRS does not require the interim disclosures, but the other stuff they would require. And then for the next slide. The SEC was largely silent during the various exposure drafts of the standard. I think there were a lot in the market that were actually surprised by it, especially since some of, if you think about the old revenue recognition standard, SEC definitely came out with a lot of different guidance that restructured almost the old standard, and a lot of there's industry guidance that came out, as well. So, there is curiosity where SEC will fall out on that. And as I mentioned earlier, SEC has started to kind of, make some waves by, or at least put in their input regarding, constituents questions and how it may impact other SEC requirements like the 5-year table. In addition to the FASB ISB Transition Resource Group, which again is slightly different for those who dealt with derivatives. It is slightly different than the derivatives implementation group who were giving out implementation guidance. The Transition Resource Group is really supposed to filter for common issues and then raise it up to the FASB and ISB to address. So they're not going to be setting any particular implementation of sorts, but just trying to find commonalities to then raise to get clarity from the FASB and ISB. The AICPA has also formed 16 different industry groups to help develop accounting guide on revenue recognition and helpful hints and illustrative examples. Again, they're not setting anything in particular, but just providing clarity so that there's some kind of, comparability across the different industries. And I know that there's a couple of other industry groups that are being planned and put together, especially as it relates to technology, social media, cloud. Some of these are issues that are now coming up, creeping up, that FASB is just now familiarizing themselves with. And with that, hopefully that didn't either get your head to explode. I'll pass this on to Dan.
Hi, everyone. I'm Dan Miller. Thanks, Trang. We're going to come back to Trang a little bit later, but just quickly, as Kim said, I run the software vertical at NetSuite. Just to be clear, obviously we serve other verticals, manufacturing, WD, e-commerce, et cetera. But we have over 800 customers in our software vertical, and we serve over 20,000 entities at NetSuite overall. And really, my point in mentioning all that is I'm sort of just the tip of the iceberg in terms of RevRec. We have deep RevRec expertise within NetSuite. We have sales reps who are former CFOs, controllers, obviously all the way down into our professional services group. So this is something we do every day. Switching gears from sort of the technical or kind of the true compliance side, we're going to now get into some of the operational things here, and if you kind of look at the next slide, the graphic on the right-hand side really kind of lays out some of the steps in a typical kind of process change situation, and really the point of showing this is that we believe, and I think others, including Deloitte and others, believe that this is a significant change for many companies. It may appear, oh, geez, the rules don't affect us very much, but when you actually kind of drill down and start taking a look at the change that will happen, they are significant. And so I think our first sort of observation here is that you should plan to have this treated as a project. And really that starts with understanding the current state. And that may sound sort of obvious, but you have to remember, at NetSuite, we support companies that are going through transitions, whether it's an IPO, whether they're growing significantly, whether a PE fund has come in and acquired the company, and now there's change management around that. So that's what we do. And when you're in those kinds of situations, just take a hyper-growth situation. You're hiring people, significant change in process, et cetera, and has to be that way. That's actually a good thing. But just really understanding that current state is actually a challenge. And so the first step as you kind of go through this change management process we think is important to point out. Once you have that current state, you can then do the next step, which is really kind of identify the gaps. What do we need? The wonderful content that Trang presented around what are the challenges that are represented in the new standard that we now have a gap and we need to go address those. Once you've achieved sort of that level of critical mass, I think you can sort of get to the second step, which is then getting alignment internally. And we think this is important because I think it's triangulated. I mean, there's legal aspects, sales ops, your sales group, compensation, et cetera, that are going to get impacted by this. And so really getting alignment outside of finance. It becomes finance is sort of the tail, kind of wagging the dog. It's going to be a challenge. And we think one how, if you will, to getting this done is something we've done at NetSuite, which is to form a steering committee. We're a $500 million company roughly this year. We're planning to go to how do we support our systems to be $1 billion software company, and so we formed that steering committee. And then one of the issues we're addressing is how we adopt the new standard. Now I have a slide on that a little bit later, but importantly, we found that when you have the various functions and the right people at the table, it makes this process change that much easier. And then once you've got the right people at the table, obviously it becomes about the process that you're going to change, but then you must have the system capabilities. And while we'll address this more as we go through here, but while there are more than these three legs to the stool, I'm going to pick these three as being the most important, in that to truly make this transition at anything other than a very low level of volume in a somewhat simple situation, i.e. if you're just shipping widgets, for example, with no other performance obligations, this is probably an easy transition. Or for any situations other than that, you're going to need a system. Doing this in Excel, doing this in spreadsheets will be, we think, undoable or highly risky, or both. And as a result, you need what we kind of call multi or parallel books. I have a slide on this later, but at a high level, this is a second set of books typically used for a statutory book, where you want to have local books for, say, your UK subsidiary that comply with the rules in that country. They don't roll up in your consolidation and whatnot, but they're sort of a parallel set of books that's recording things. And that's what will help now. That's what we've architected in NetSuite, to be able to have companies help them make that transition to the new standard. Again, I'll spend time on this a little bit later. We think integrated revenue recognition is critical. We think point solutions have their place in certain situations, but overall, we think having an integrated RevRec solution is critical. And an example of that will be just the ability to handle deferred costs. So as you reallocate, and we'll get into this, as we reallocate revenue and then reamortize and adjust revenue throughout a contract in some of the situations that Trang was laying out, the ability to then also defer and match the costs associated with those adjustments in revenue is critical. And the final thing we think you need is really powerful workflow, the ability to kind of have new workflows take place, complex workflows that are conditional upon certain things, to be able to support that. And that's not just important to get the work done and to get the transactions processed, but also around a control environment. For the public companies, obviously, to be able to do the SOX compliance work, the audit trails, et cetera, having that all in the system as part of the workflow, we think is a critical step. So those are kind of three critical things we think companies are going to need to make the transition to the RevRec standard, the new RevRec standard. And how NetSuite does this is really on the next slide. And this is really why we think we're the leader in the RevRec area, is really this system. And I'm going to spend a minute on this slide, so this really is set up for the next slide. But I've seen a summary this week really that 90+% companies are either have done nothing or are really just starting to take a peek at this area. And we think that this system that we show here and that we have at NetSuite will allow us allow our companies to make this transition. So what I'll say here quickly, and then we'll move on, is NetSuite's at a really interesting stage of its company's life, and that we have lots of resources, lots of functionality in our software, but we still have people that you can reach out to. And what I'd say is, rather than sit here and tell you all about our systems, feel free to contact me directly, Dan at NetSuite, if you you want to know more about our system, and I'll definitely tell you more, and we'll fill you in on all of our wonderful RevRec functionality, which is really what I'd like to focus on next. So if you kind of double-click on that 10 o'clock where it says revenue recognition, and you go to the next slide, this lays out our architecture for the revenue lifecycle. So if you're a revenue recognition expert, and I probably won't dive into this to get into the gory details, but I do want to do it some justice by kind of talking about each of these key steps that really enable this transition. So why is this architecture important to you as a controller, revenue director, et cetera? It really involves things like Trang was talking about, which are things like variable consideration, where you have to bring and link two contracts together, or where you have tiered pricing, where those things happen, those change over the life of a contract. So and I won't go through each of these boxes in detail, but if you kind of start at the top, the step that we call construction, which is our ability to really kind of assemble various agreements. So again, say you have contract A and contract B that are separate contracts, and under the new standard, you're required to link those orders. That's what we do there. We kind of construct them. We provide a way of seeing that, visibility around that, so that then you can do allocation, which is a key step in the process that Trang laid out, and really identifying the key elements and then allocating the consideration across those through an integrated rules engine. So versus, say, having to write scripts, et cetera, we'll have predefined rules to be able to do the kind of allocations that companies are doing today, and will continue to have to do in the future. I talked a little bit earlier about linking orders. So as you get into a contract and you go through the process and things are changing, the ability to do adjustments and have those allocations be performed, reallocations be reperformed on the fly. So this cycle is happening. We're able to then create contingencies and exceptions. So if you, for example, have a contingency around services needing to be performed before you start revenue recognition, we establish that rule, and then how we translate these rules, and really sort of then you get into the accounting, is really that we then create a charge. This is how we then create journal entries, amortization schedules, and the like that we all in the accounting function need to be able to perform our work. We think that billing integration is critical. We see frequently, and you all may have this situation where you defer revenue or have some contingency or dependency on billing, payment, et cetera. So we think integration with a billing capability is critical. And then we translate those into reports. So what we, at the end of the day, have to deliver to auditors, et cetera, is the ability to then do roll forwards, waterfall reporting, et cetera, and then importantly for management, key metrics. So as we know in the SaaS space, there are a variety of key metrics around lifetime value, et cetera, that folks look at. And so the reporting of those analytics, along with the audit reporting, we think is critical for our customers and for companies making the transition to the new standard. If we then double-click, next slide, this is the architecture that we chose, and it really does enable folks to address the non-accounting aspects. And so I'll throw it back to Trang to talk about some of those.
As Dan highlighted, I would say that this is probably one of those areas I think we have a tendency from, company perspective and then also an accountant's perspective to say that, hey, this is really just an accounting issue, let the accountants handle it. But the reality is this is one of those standards where it's really just more than just an accounting issue. I mean, I think we've highlighted a few of the issues or some of the challenges that come into play, and it really forces the accountants to really understand the contracts, not only the contractual terms, but how they actually operate, what do the sales side do, what the distributors do, and things like that. So it kind of forces you to really understand the economics of the transactions itself. Having said that, I will say that, I did mention debt covenants before, but, Dan highlighted as well the impacts to employee agreements. You may have contracts that will say someone's bonus is based on how well the company does, and maybe in the past the company recorded revenue based a little bit more on cash basis and deferred revenue and things like that. So to the extent that you're accelerating revenue because of the new revenue recognition standard, you may get to a point where if you don't look at how it may impact employee agreements, you're paying bonuses to people, to employees well before, cash collections, or, and maybe that's not your intent. So there are things like that that the company should consider. What are the overall overreaching type impacts to other agreements? Also, early adoption is permitted for foreign entities. So to the extent that you have international operations that are under IFRS, if they so choose, and I'm hoping that, again, it depends on where corporate is. Sometimes corporate is over there. Sometimes corporate is here in the U.S. So it just kind of depends. And, one of the other things that I can't emphasize enough is really the communication of key stakeholders, where you are in the process, and then also impacts or potential impacts that you may see to your business model. It also takes discussions with your operational side to see if there's changes that you want to make to contracts, to how you do business, and how you transact and communicate. And then also, if you're planning on any system or process changes, companies really should understand what that is, and whether these are things that you want to then determine, okay, here are the revenue recognition, here are the new requirements under the new revenue recognition guidance. Is this something that the system can handle? Are there changes that we need to tweak? And it's being up, in front of it rather than having to implement twice, right? If you're already in the process of, I had a couple companies already where they're in the process of implementing, an ERP system, and they didn't talk about the new Rev Our Standard, and they're just basically plugging away, and they'll just have to go through that implementation twice if they're not having that conversation between the finance organization and the IT department. And then the question also, would the systems be able to track everything that you need to support from an accounting analysis? And I think another area to consider is taxes and changes to process, because, again, next slide, we start talking about the issues with processes. So even if, you feel like a lot of the companies now, when you think about software companies, they feel as if the new revenue recognition guidance is similar, not exactly the same, similar to the software revenue recognition guidance that came out and had to be implemented a couple of years ago. However, there is general agreement that what they were able to do in spreadsheets before now becomes unmanageable, and Dan highlighted the constant, re-estimation and the allocation you're going to have to do, and looking at contract combinations and modifications and things like that. And so whether your systems and processes can handle that, even if you're doing things, by Excel or, other types of spreadsheets, can you really support that on an ongoing basis, especially when you think about the close cycle and how that gets impacted. And then the next slide regarding taxes. This, I think, goes unnoticed by many, but in some cases, you will accelerate revenue. And under the, IRS tax code, revenue is really contingent on U.S. GAAP. So as you're moving that forward, there's going to be some tax planning. Are you going to even have the cash to be able to make those cash payments if somehow you thought that maybe the revenue wouldn't be recorded until another 5 years? Now you've got this catch-up, especially if you do the modified approach, that all of a sudden you've got this huge revenue that you've recorded into retained earnings, and, what's the related tax that would have to go with that. And then in other jurisdictions, especially when you think about international tax planning, they may not have a similar type guidance, and it would be something else. So it's really important to kind of bring tax into this, especially international tax planning, into it earlier rather than later in the process. And I think passing this on to Stephanie to kind of talk about, what her company is doing as it relates to the implementation of the standard.
Hello, everybody. Wow, that was a lot of information. So I'm the Director of Finance Operations at Hortonworks. If you can go to the next slide. Here's a little bit about us, and what I would say about those 6 gentlemen that you see there is that, in time there will be among the founders of big data, the whole concept of big data. So if you know anything about Hortonworks, any time you hear about big data, it's probably powered by Hadoop, and Hortonworks is the one of the primary contributors to the Hadoop architecture. So as you can see, we're only 3 years old. We've been growing very rapidly in a really huge market space, heavily competitive, fast ramp. So it's been quite a ride. Next slide. So our customers are typically Fortune 1000. We have a lot of sophisticated customers, gobs and gobs and gobs of contracts. A lot of them have their own way of doing things. We've had to sort through piles and piles and piles of contracts, language, most favored nation clauses, acceptance language, you know, multiple multi-element contracts. A lot of our customers will start with a POC. The next quarter, they increase their cluster. The quarter after that, so it's just been like, you know, they might have 2 or 3 or 4 multiple element arrangements per year. So, and coming at me at quite a pace. So that's kind of the environment that we've been working with since day one. Next slide. So we went live on NetSuite pretty early on, and what we did was we made the commitment that we are going to use the system and all of its capabilities to keep all of the activity in the system. So I can say that, you know, 2.5 years later, we've been on NetSuite. We are 100%, all of our revenue activity is on the system. I don't have any offline spreadsheets to track any of this stuff. We have granularity by business, you know, line of business, each month how much the recognition is, the type of orders that there are. We have all that granularity in place that's been built out over time, a little bit every week, every day, every month. It's very, very easy to get NetSuite to kind of grow with you and make small incremental improvements. This is kind of the standard NetSuite process flow, and it's really this simple that we just have a bunch of reports that go out that show where things are in the queue, who they're filtered on various dimensions, like this one's really hard, so that needs to go to this person over here. This one's easier, so this person over here can tackle that one. And so there's just kind of these, as these things make their way through, because as you know, in these multiple element arrangements, you can't just, you know, do the contract, do the transaction, set the revenue recognition. It's much more complicated than that. You have to wait for commencement of services or commencement of all the elements together. How do we decide which has got acceptance criteria? So we've got all of these things flagged. So we start with a sales order, which is the story of the deal, taking that contract, turning it into a transaction, and then as the story unfolds over time and gets added to each quarter. We've done everything inside of NetSuite. Next slide. So we have microgranular recording. We've been pretty much doing all the things that would be prescribed in the new rules, because currently, even though our recognition pattern is fairly straightforward in terms of being ratable, we still have multiple business units that want to know what their piece of that pie is. So I still have to be able to answer the question: what got recognized for the support department? What got recognized for the PS team? What got recognized in training? You know, what's still to be recognized? What got delivered that month versus recognized? So we're pretty much able to answer all those questions fairly quickly. Next slide. That's it for me.
Dre?
Okay, next slide. So these are just general implementation considerations. I will say that having gone through the whole IFRS, US GAAP type thing, one general mistake that companies kind of do, and auditors are just as guilty, to be honest with you, is we complain that US GAAP is so prescriptive, but yet given the opportunity, like this new Rev Our Standard, to kind of really reflect what your business really is, we tend to kind of migrate towards packaging it back up to where it was before so that we don't have a lot of changes. But I will say that some companies who have started early on this, they are starting to look at how they do business and how they package and price their products differently. One company I talked to, they said that they're changing their commissions and they're going to link it, specifically by product, so that when the product actually gets sold, they know exactly what commission needs to be amortized. Others are starting to talk, to their business units and determining what are some of the upcoming changes to products and contracts, as well as any planned system implementations and upgrades. One important thing to kind of think about when you're doing these implementations is understanding where your business will be, and kind of developing use case scenarios, and determining what are the appropriate accounting policies and approaches, and getting that buy-in from all parties, and determining that up front so that you can navigate any business requirements that you need and any potential impacts to processes or systems. Next slide. This is just illustrative of all the different things that you'll have to think about when you think about the roadmap, and as you're implementing this. One thing that I will highlight is if you look at this, it's pretty early on that you should engage your external auditors. It's really important to kind of get their buy-in because there's going to be so much judgment and subjectivity in this. And so if you can kind of get their sign-off before you spend too much, effort and resources on something, you at least know you're tackling it in the right way without having to kind of get there already and then having the auditors then basically say that they don't agree, right? So and I think Dan's going to go through, this plan as well, or similar plan for them, but it is important to kind of engage your auditors pretty early in the process. Next slide.
Thanks, Trang. So this is sort of a takeaway slide, between Trang's slide and mine. You kind of get a sense for some things. So we thought this would be helpful to help, kind of the audience think about what are the things I need to be thinking about. And I think Trang's talked a lot about these. One example, though, I thought I would pull out quickly is on the left-hand column, the desktop procedure. So I'll talk more about what NetSuite's doing, but it's a great example around how you really have to drill down to what your order processing group is doing to really reflect the requirements of the new standard around process, estimates, et cetera, and how to get approvals. But when you really get down to how these things are working, you're going to have to think through these things at a very detailed and operational level. Next slide. I mentioned earlier I would come back to how multi-book plays a role in the transition to the new standard, and this is just a kind of a picture of how that would work. So just kind of walk you through this slide. If you look at the top, there you are, current gap, and everything is great, and along comes the new standard, and you're now subject to a new set of rules. And how do you keep your thousands of, just as one example, your thousands of orders simultaneously both in current gap as well as your rules that you've, to Trang's point, you've kind of gone to your auditors and said, okay, well, this is going to change. How do I recompute my revenue recognition according to the new set of rules? And that's where parallel book comes in. So you would be simultaneously keeping one, you enter your orders once, we define the rules according to whatever the rules are in each of those two cases, and then we would cut over, if you will, to the parallel books when that transition period occurs in the public company, 2017. You would then need to keep those old set of books for disclosure purposes. So to be clear, it's important to be able to do that transition, not just the one way, but then to keep the old books for the purposes of disclosure requirements and just history in general. So we think without this capability, if you're trying, again, if you're trying to do this in spreadsheets, we think that will be incredibly difficult, if not impossible, and certainly highly risky. So just to kind of to put a bow on it, very important functionality that NetSuite has, and we think is critical to making the transition. Speaking of making the transition, next slide. This is so now I'm not talking about NetSuite, the software vendor. I'm talking about NetSuite, the company, the public company with the stock symbol N. So this is how we're going to make the transition. This is courtesy of our corporate controller, Mike Foreman. At a high level, here are the steps that we're taking, and you can see we're actually a little bit ahead of the curve in terms of kind of what I've seen out there. We've actually done a lot of the planning internally, our steering committee, as well as kind of the folks in our accounting group, as well as in identifying the gaps. We will kind of work through the process, and then we will wait, whatever the exact timing is going to be, and it's coming out in pieces. But we think by Q1 we'll have some more guidance from the AICPA and the big firms to be able to kind of hone in on and get confidence in that our, kind of our interpretations and our discussions with our auditors are kind of where it's going to turn out in court of these industry groups, and et cetera, and being compliant with those. We'll then build our systems, as I said, desktop procedures, et cetera, and keep an eye on what the transition amount will be. And then we'll obviously make this cutover in terms of which of the paths we choose. We have not chosen yet, but we're working through with our audit committee. But that's an active dialogue. It's where we will use our multi-book capability to be able to do this and be able to make this transition. So as a reasonably large public company, this is our process. And then I think our last slide is Stephanie talking about kind of what Hortonworks is doing.
So we're just continuing to plan for success. We're a venture-funded company, and so we obviously want to continue to grow rapidly and at some point have an event that's favorable to all of us option holders. So we're just planning on success on all levels, and we know that our ramp will continue to grow fast. Our customer base is growing by leaps and bounds every quarter. So we just are still committed to the continuous improvement and enhancement of our systems so that we have, very organized, rich data source that we can do the analytics. We have all the history, and then we can tweak it to go forward.
Great. I think we're ready to move into the Q&A portion of the webinar. We have a lot of questions. We'll do our best to get to as many that we can. However, if you submit a question and we don't have an opportunity to answer it here, don't worry. We've captured that question, and someone will get back in touch with you to get that question answered for you. So we actually have quite a few people on the webinar who are using spreadsheets for revenue recognition. We have several questions along this line. Basically, people are really trying to get a feel and want to hear from the speakers as far as, when does it really make sense to look at a system to handle your RevRec? Are there certain milestones that they should be looking for? Is it a revenue milestone? Is it something else? So we'd like to get our speakers to weigh in on that. I think, Stephanie, you'd be an ideal first person to address that.
Well, I lost patience with the spreadsheet in year one at Hortonworks, like within the first 6 months. We only had about 10 customers at the time. So I knew right away that we needed to get this on the system, and so how are we going to be able to do that? And so I don't think there's any time that's too soon. If you get everything in there and then you're able to form some of the reporting that goes in there, I don't have to use any spreadsheets for analytics or anything. I do use Excel for a front-end tool, but it's just really it acts on the NetSuite data. So anytime that I need, anytime I do a lot of updates or a lot of changes or we change policies, I'm going to go back and modify some of their previous recognition schedules. It literally takes me a minute to just update and get everything current. So I don't think it's too soon. And what's nice about NetSuite is you can just kind of do it in little bites at a time.
So this is Dan. I'll just quickly add two things. So let's remember RevRec is at the end of the day, it's compliance with a set of rules. Typically it's a stage of company's life, right? So when they can see some reason for that, obviously IPO being one example, and then sort of just getting away from kind of the compliance aspect and then getting to the operational or value creation side. It's really about, kind of reporting and KPIs. So we see companies wanting, again, I spend most of my time with software companies. So it's those key metrics around, ARR, MRR, et cetera, whatever the metrics are. So those metrics become very important and critical to the lifeblood of SaaS companies. Trang, do you have anything to add?
I would say that it's not really any particular threshold per se. I think it's kind of important that you're going through this, and as Stephanie had noted, as you're going through this and you're realizing the efforts it would take to get the information you would need for financial reporting. Again, each company is going to have their own challenges when it comes to the revenue streams, how you contract, how you actually, if you're going to have a lot of contract modifications and things like that, that just adds complexity to it all. And you'll soon realize once you kind of get through use case scenarios and figure out how the accounting would work every single time you have a different fact pattern, I don't think it would take long for you to realize that you probably need to migrate away from spreadsheets. And I think, like I mentioned before, even though for some companies, like software companies, they realized that this wasn't a huge accounting change, they did realize that, for them, they could not manage it in spreadsheets anymore.
Okay, thanks everyone for weighing in on that one. There was quite a few questions came in toward the beginning when Trey was really going through the technical accounting pieces. I pulled one out that I think might resonate well with the audience, and that is, how does a warranty, not an acceptance, affect RevRec for companies that operate with a SaaS model?
Read that again, Kim.
It says, how does a warranty, not acceptance, affect RevRec for a SaaS company? And this was back on the very detailed slide that you were starting with, Trey.
Yeah, and I'm not sure if I'm fully addressing this, but the issue with warranties are usually not your standard warranty like that's governed by just laws, right? The usual warranties that you would see just from a good practice of business. But for those where you have warranties where there's either a specific acceptance piece or an additional warranty that someone can purchase, in those cases, that may constitute a separate performance obligation. And even though they are packaged with your contract or your product, because it constitutes a separate performance obligation, you would have to allocate a portion of the revenue to that separate performance obligation and wait until either that warranty, like someone's acceptance or the warranty period has expired before you can actually record the revenue associated with that. But basic warranty that you would normally see on, a product that it's just standard isn't really considered a separate performance obligation. There's certain criteria that you would just have to evaluate. So it just kind of depends on the facts and circumstances.
Thank you, Trey. We're at the top of the hour now, and I want to be true to the time that you allocated for today's webinar. Thank you very much to everyone for joining. And for those of you, like I said, if you submitted a question and we didn't get a chance to get to it, someone from NetSuite will circle back with you. Thank you again, and have an enjoyable day.